Good morning. I am Kalai Chelbi, Assistant Professor of Commerce from School of Arts and Science, Dhanlakshmi Srinivasan University, Trichy. In this video, I am going to explain Goods and Service Tax, which covers the history of GST, Indian Indirect Tax System, features of indirect tax, canon of taxation, and the concept of VAT. From this, you can understand the evaluation of the Indian indirect tax system, the features and importance of indirect taxes, the canon of taxation, and the concept of value added tax. Indirect taxes are taxes that are not paid directly by individuals to the government. Instead, they are charged on goods and services that we buy and use in our daily life. First, indirect taxes are levied on goods and services. This means whenever we purchase items like clothes, foods, mobile phones, or use services like transport or internet, a tax is included in the price. Example of indirect taxes include GST and sales tax. The tax burden is shifted to consumers, although the government collects the tax from sellers or manufacturers. The actual burden is borne by the final consumer. For example, when you buy a product, the price you pay already includes tax, so you indirectly pay the tax. Indirect taxes are collected by intermediaries such as manufacturers, wholesalers, and retailers. These intermediaries collect the tax from consumers and then pass it on to the government. They act as a link between the government and the consumers. Indirect taxes are important source of government revenue. Since people consume goods and services every day, the government earns revenue regularly through indirect taxes. This revenue is used for public welfare activities such as building roads, schools, hospitals, and providing other public services. History of Indian indirect tax system. The Indian indirect tax system has evolved over a long period of time. Let us understand its development step by step. In ancient India, taxes were mainly levied on trade and agriculture. Traders and farmers paid taxes in the form of money or goods to the king. These taxes were used for administration, defense, and public welfare. References to such taxes can be found in ancient texts like the Arthashastra. During the British period, the indirect tax system became more structured. The British government introduced taxes such as excise duty, custom duty, and sales tax. These taxes were mainly imposed to generate revenue for the British administration and to support their economic interest rather than for the welfare of Indian people. After independence, India adopted its own indirect tax system. The government introduced different tax at both central and state levels. Central excise duty was levied by the central government on the manufacture of goods. Sales tax was levied by the state government on the sale of goods within their states. Service taxes was introduced in 1994 to tax services such as banking, insurance, and telecommunication as the service sector was growing rapidly. Over time, this led to complex and multiple tax structure before GST. Different taxes were levied at different stages by different authorities with varying rates and rules across states. This caused confusion, increased complaints burden, and resulted in problems like the cascading effect of taxes. Because of these issues, There was a need for simpler and unified tax system which ultimately led to the introduction of goods and service tax in India. Problem of pre-GST indirect tax system. Before the introduction of GST, India followed a complex indirect tax system with many drawbacks. There were multiple taxes at different levels. The central government and state governments levied different taxes such as excise duty, service tax, VAT, octroi, and entry tax. This made tax system confusing and complicated for businesses. There was cascading effect of taxes, also known as tax on tax. This happened because taxes were charged on top of other taxes. For example, excise duty was charged during manufacturing and then VAT was applied on the price that already included excise duty. This increased the final price of the goods for consumers. There was a lack of uniformity among states. Each state had its own tax rates, rules, and procedures. This created confusion for businesses operating in multiple states and results in unequal tax burdens across the country. The system involved a high compliance cost. Businesses had to maintain multiple records, files, different tax returns, and follow various laws. This increased administrative costs and especially affected small and medium enterprises. Finally, there were barriers to the free movement of goods. Taxes like octroi and entry tax led to checkpoints at state borders. This caused delay, increased transportation costs, and disrupted the smooth flow of goods across the country. These problems paved the way to the uniform tax system. Features of indirect taxes. Indirect taxes have several important features that distinguish them from direct taxes. First, indirect taxes are paid indirectly by consumers. Consumers do not pay these taxes directly to the government. Instead, the tax is included in the price of goods and services. Whenever we purchase a product or use a service, we indirectly pay the tax. Indirect taxes are collected by manufacturer or sellers. Producers, wholesalers, retailers, or service providers collect the tax from consumers and then transfer it to the government. They act as intermediaries in the tax collection process. Next, indirect taxes are convenient to collect. Yes, since the tax is charged at the time of sale or production, it becomes easy for government to collect revenue. The tax amount is usually small and paid in parts, so it does not feel like a heavy burden to consumers. Next, indirect taxes have a broad tax base. Almost every person contributes to indirect taxes because everyone consumes goods and services. Even people who do not pay income tax still contribute to government revenue through indirect taxes. There is less resistance from taxpayers. Because indirect taxes are included in the price of goods and services, consumers do not feel that they are paying tax directly. As a result, there is less opposition to indirect taxes compared to direct taxes. Indirect taxes are regressive in nature. This means that they affect poor people more than rich people. Both rich and poor pay the same tax on product, but the tax forms a higher proportion of income for the poor. Therefore, the burden of indirect taxes falls more heavily on the low income groups. Canon of taxation. Principles laid down by the Adam Smith. The word canon means rules, principles, or guidelines. In economics, The canon of taxation refer to the basic principles or rules that a good tax system should follow. These principles were laid down by Adam Smith, a famous economist. The four basic principles of taxation are known as the canon of taxation. These principles helps in designing a fair, simple and efficient tax system. In simple words, canon equaled basic rules or principle. First, the canon of equality. Tax should be fair. According to this principle, tax should be imposed according to the ability to pay. People with higher income should pay more tax, while those with lower income should pay less. This ensures fairness and reduces inequality in society. Second, the canon of certainty. Tax should be clear. This principle states that the amount of tax, the time of payment, and the method of payment should be clear to the taxpayer. There should be no confusion or uncertainty. Certainly helps taxpayers plan their finances and reduces the chances of corruption. Third, the canon of convenience. Tax should be easy to pay. According to this canon, taxes should be collected in a way that is convenient for taxpayers. The tax should be paid at a time and in a manner that causes minimum difficulty. For example, tax deducted at sources or tax included in the price of goods is convenient for taxpayers. Finally, the canon of economy. Tax should be economical to collect. This principle states that the cost of collecting taxes should be as low as possible. A good tax system ensures that a large part of the tax collected reaches the government treasury and very little is spent on administrative and collection expenses. Next, meaning of value added taxes. Value added tax, commonly known as VAT, is a type of indirect tax. It is a tax that is levied on the value added at each stage of production and distribution of goods. This means that tax is charged only on the additional value created at every stage, such as manufacturing, wholesaling, and retailing, and not on the entire value of the product each time. One important feature of VAT is that it eliminates the cascading effect of tax, also known as tax on tax. Under VAT, a seller pays tax only on the value added because the tax already paid on inputs can be deducted. VAT is charged on the sale of goods within a state. Whenever goods are sold, VAT is included in the selling price and collected from the buyer. Another key feature of VAT is that credit is available for tax paid on inputs. This means that if a manufacturer or seller has already paid tax while purchasing raw materials or goods, they can claim credit for the tax and deduct it from the tax payable on sales. This ensures fairness and prevents double taxation. Overall, VAT made the tax system more transparent and efficient compared to earlier systems, and it's helped to reduce the tax burden on consumers. Concept of value added tax. The concept of value added tax or VAT is based on taxing only the value added at each stage of production and distribution of goods. First, VAT is levied only on value addition. This means tax is charged only on the extra value created at each stage, such as during manufacturing, wholesaling, or retailing. It avoids taxing the same value repeatedly. Second, VAT works through an input tax credit system. Under this system, a seller can deduct the tax already paid on inputs or raw materials from the tax payable on sales. As a result, tax is paid only on the value added, which helps in reducing the overall tax burden. Third, VAT provides a transparent tax mechanism. Since tax is charged at every stage and proper invoices are required to claim input tax credit, all transactions are recorded. This increases transparency and reduces tax evasion. Finally, VAT encourages tax compliance. Business are motivated to issue proper bills and maintain records so that they can claim input tax credit. This creates a self-checking system where both buyers and sellers follow tax rules. VAT is considered a precursor to GST. The principles of value addition, input tax credit, and transparency under VAT formed the foundation for the goods and service tax. GST expanded these concepts by including both goods and services under the single unified tax system. Variants of value added tax. Value added tax can be implemented in different forms depending on how capital goods are treated. These forms are known as variants of VAT. There are three main variations. First, the gross product variant. Under this variant, no deduction is allowed for capital goods such as machinery and equipment. Tax is charged on the total value of output, including the value of capital goods used in production. As a result, this variant leads to a higher tax burden and is rarely used in practice. Second, the income variant. Under the income variant, partial deduction is allowed for capital goods. Instead of giving full credit at once, the cost of capital goods is deducted gradually through depreciation. This method reduces the tax burden compared to the gross product variant but still involves some complexity. Third, the consumption variant. Under this variant, full deduction is allowed for capital goods in the year of purchase. This means businesses can claim complete input tax credit on machinery and equipment used for production. Tax is therefore levied only on consumption, not on investment. The consumption variant is the most widely used for VAT because it encourages investment, avoid double taxation and simplifies the tax calculation. This variant also forms the basis of modern tax system like GST. Methods of VAT calculation. Value added tax can be calculated using three main methods. First one is invoice method. In this method, tax is shown separately in the invoice for every sale. Businesses can claim input tax credit based on invoices of purchases. This method is widely used because it ensures transparency and proper record keeping. For example, if a manufacturer buy a raw material for rupees 10,000 with 1000 VAT and sells goods for 15,000 plus 1500 VAT, the VAT is to be paid to the government is 1500 minus 1000 is equal to 500. Next method is subtraction method. In this method, VAT is calculated as sales minus purchase. Only the net value added is taxed without directly using invoices for each transaction. This method is simpler but less common because it requires accurate accounting of total sales and purchases. Third one is addition method. In this method, VAT is calculated on the total value added, which is the sum of wages, profits and other costs added during the production. This method is mostly theoretical and not widely used in practice because it is complex and calculated. VAT as a step towards GST. Value added tax was an important step in Indian journey towards GST because it introduced several reforms in the indirect tax system. VAT reduces the cascading effects of taxes. Earlier, under the old sales tax system, tax was charged on the total value of goods at every stage, leading to tax on tax. VAT allowed input tax credit, so businesses paid tax only on the value they added, reducing unnecessary tax burden. Second, VAT improved tax compliance. VAT required businesses to maintain proper invoices and records to claim input tax credit. This created transparency and encouraged businesses to follow tax rules. Then, next, VAT simplified the tax structure. It replaced multiple indirect taxes like sales tax, turnover tax, and excise at the state level. Tax calculation become easier and more systematic, preparing the way for a unified tax system. Next, VAT laid the foundation for GST implementation. The principles of value addition, input tax credit, and transparency introduced by VAT became the core idea behind GST, which expanded the system to cover both goods and services under the single tax. In short, VAT was like a practice round before GST, teaching the government and businesses how to handle value added taxation, input credits, and compliances, making the transition to GST smoother. Uh, at last, the summary: the Indian indirect tax system has evolved over time to become more efficient and transparent. In the earlier years, there were multiple taxes at different levels, which caused confusion and lead to the cascading effects of taxes. The introduction of VAT improved tax efficiency by taxing only the value added at each stage and allowing input tax credit, which reduced unnecessary taxation and encouraged compliances. Later, the goods and service tax unified all indirect taxes into a single nationwide system covering both goods and services. This unified tax system helped to simplify the tax structure, increased transparency, and create a common national market, allowing goods and services to move freely across state without multiple tax or barriers. India moved from complex multiple tax system to VAT and then to GST, making indirect taxation simpler, fairer, and more efficient. Now you can able to answer the question, what is direct tax? Yes, you know that a direct tax is a tax that is paid directly by a person or organization to the government and cannot be shifted to someone else. For example, income tax. An individual pay it directly on their income. Next, why is GST called a unified tax system? Yes, GST is called a unified tax system because it replaces multiple indirect taxes with one single tax applicable across the entire country. Earlier, there were different taxes like VAT, service tax, excise duty, and sales tax at the central and state level. GST combines all these into one tax with uniform rate, making it easier to collect and reduce confusion. It is applied on both goods and services, ensuring a common tax structure nationwide. GST unifies taxes, creates a single national market, and removes multiple state and central taxes. Yes, I think you have clearly understand the Indian indirect tax system. Thank you for watching. We will meet in the next video. Bye. Take care.